And the next question goes to Annette Weisbach of CNBC. Annette, please, here in the middle.
President Lagarde, thank you very much for taking my question. I have one on what are you expecting in terms of time lag? If you raise rates in July, when will you see an effect on inflation and inflation expectations? And will that ultimately also mean that you have to lift rates to a neutral rate? And that would be my second question, because I think there's a lot of guessing around what you think the neutral rate actually is. Is it 1.5? Is it 2% for the euro area? Perhaps you could give us a bit more of an insight. Thank you.
So, do we expect that July interest rate hikes will have an immediate effect on inflation? The answer to that is no. And I would like to develop that a little bit. First of all, because of the anticipation of our monetary policy, because of the inflation and growth outlook, financing costs have already moderately but significantly increased, whether you look at corporate bonds, whether you look at sovereign bonds, whether you look at bank, of course. Those financing costs have increased. And with the signal that we're giving here, particularly concerning the short-term rates, this signal will continue to have an impact on financing costs. Now, typically, monetary policy decisions have a longer-term impact in relation to inflation itself. So we have to stay the course, be determined, committed to delivering the 2%. But we cannot expect that to happen on the 22nd of August for a decision that, 22nd of July for a decision that we would have made in July. On the other hand, because you mentioned inflation expectations, we observe that inflation expectations are well anchored. And we certainly want to indicate to those who form expectations, whether they're markets, whether they are experts, whether they're consumers, that we are determined to delivering on our target of 2% in the medium term. And therefore, expectations should absolutely remain anchored because we will deliver. Oh, the neutral rate. This is a topic that we have deliberately decided not to have on the occasion of this Governing Council meeting. And I'm sure that we will ad nauseum argue as to whether it is 0.96 or 1.97 or beyond or below or whatever. Suffice to say that the neutral rate over the course of time, for multiple reasons having to do with productivity, with demographics and all the rest of it, has gone down. But where it stands exactly, we have decided not to discuss it on this Governing Council meeting. And believe me, we had plenty to discuss, so we saved a little bit for later. And, you know, to be fair as well, it's not something that you can observe and determine with precision today. Is as you get closer, we will understand better where exactly it stands. And we will debate it. I have no illusion on that. Thank you.
Thank you. And the next question goes to Dan Ballacher of Volkskrant. Dan, please.
Good afternoon. Thank you for taking my question. Is the end of the asset purchasing program a good time for you maybe to adjust the forward guiding policy? Because when it was introduced in 2013, it was meant to manage market expectations. But now it seems like the ECB would have stopped the purchases earlier, if not for the promises made, even though there was an extraordinary inflation-inducing event like the war in Ukraine. Is the tail, financial markets, not wagging the dog, the ECB, instead of the other way around? My second question is related to this one. The ECB believes inflation will fall down back to target by 2024. But for most of the past decade, the ECB also consistently thought that the inflation rate, which was then too low, of course, would converge to its target, and that also didn't happen. So how firm are your beliefs that you are going to succeed now, as historical experiences do not imply great credibility?
First of all, on the issue of forward guidance, I'm assuming that you're referring to the forward guidance relating to asset purchases. Yeah. So if you look at that forward guidance, we have actually changed it. If you recall, the forward guidance that we had referred to favorable financing conditions and to accommodative, there was a qualifier as well, but it referred to the accommodative aspect of our monetary policy. We have changed that, and if you look at the third paragraph on the second page, we do refer to the fact that we will do so for as long as necessary to maintain ample, not favorable, ample liquidity conditions and an appropriate monetary policy stance. So we take account of the change that has indeed taken place. And you're right, we are in a different universe. A lot of the tools, the forward guidance, the considerations over the last 11 years had to do with exactly the opposite movement, trying to bring inflation up because it was too low and often at risk of deflation. Now we are in the opposite situation, where inflation is too high and we need to bring it back to our target of 2% over the medium term. Now, how confident are we about our projections? First of all, I'd like to say that our staff does the best work they can do and apply their whole consciousness and professionalism to producing those projections. Second, those projections are not just the ECB. The projections that you have in front of you are the projections of the entire Euro system. So it's the ECB and 19 national central banks, including the great Bank of the Netherlands, which has actively and always actively participates in this exercise. So it's a cohesive work that is done, that is tedious, that is iterative, and that really checks everything. Third, it is clear that the massive energy prices hike and the war in Ukraine and the fast pace of the recovery have taken all forecasters by surprise. You know, I thought you would ask me a question like that. So what did I do? I looked at other, I hope I can find it now. Anyway, it doesn't really matter if I don't find it. The point being that all international institutions, all forecasters of repute have actually made the same mistake of underestimating or not anticipating some of the developments, such as the war, such as the energy crisis. Fourth point, I think we, the Euro system, and the ECB in particular, we are the only central bank which has gone back to the work that was done, which has looked under every stone to understand where the errors came from. And I use the word errors with some trepidation because it's misforecasting caused by very unpredictable events. 3/4 of the forecasting errors is actually attributable to energy prices, and the rest is largely attributable to bottlenecks that have lasted longer than had been anticipated. So, again, they do everything they can as well as they can. They make the same kind of forecast as other international institutions. Events that have developed are not captured in either models or sometimes just the sheer imagination of us all when we talk about the war at the doorstep of Europe. And fourth, we do the introspective exercise of trying to find out where it went wrong, and we will continue doing so in the future because we have to improve, no question.
Thank you. And the next question goes to Mark Schreurs of Börsenzeitung. Mark, please.
Yes, thanks for taking my questions. The first one is on reinvestments. In the past, you've stressed several times the importance of the stock of assets compared to the flow. Now you have reaffirmed to reinvest, especially the PEP payments, principal payments, at least until the end of 2024. That means a huge monetary stimulus for years. Is that appropriate if you, at the same time, are talking about normalizing monetary policy? And the second one, just for clarification, why do you today already exclude a 50 basis point hike in July?
On the reinvestment policy that we decided for PEP and for the APP, both of them, will now be operative as of the 1st of July for APP and has already begun for PEP. It is a matter that we will be discussing within the Governing Council, which we have decided not to debate today. We had, as I said, plenty to do already in the last couple of days, but we will be looking at it. And I have to tell you something. There are some of us on the Governing Council who will be interested not only to deploy flexibility, if warranted, on classes of assets, by jurisdictions, over temporality, but some of us are also interested in looking at how we can support the financing of the measures needed against climate change. I said already before that a green LTRO was interesting to consider. I think the reinvestment decisions that we will make in the coming months and years might also be inspired by this concern that we have. Okay? So that's point number one. Your point number two is, why not 15 July? Well, we are coming out of 11 years of no interest rate move. We are on our path to exit negative interest rates soon. It is good practice, and it is actually often done by most central banks around the world, to start with an incremental increase that is sizable, not excessive, and that indicates a path. As I said, the decision that we have made today are not just one intention of one single month of July. It's a whole journey that will take us back to the 2% target in the medium term. We also want to observe how markets are going to operate. And as I have mentioned, we couple our July determination with our September indication.
Thank you. Next question, Martin Arnold. I think you raised your hand, of the Financial Times.
I did. Thank you for taking my my two questions. Hello, Madame Lagarde. Could I ask, first of all, is this announcement today a signal that you are dropping gradual normalization in preference for a whatever-it-takes approach to tackling undesirably elevated inflation? And secondly, could I ask on tackling fragmentation that you mentioned earlier, the new instruments that could be designed and launched, would those only be designed and launched once the existing instruments, i.e. PEP reinvestments, have been fully utilized? Thank you.
I want to take you back to the monetary policy statement, because I think that the key principles that we will be inspired by in order to be predictable by you, but also to set the rules according to which we will proceed, are captured on the top of page 2 and say the following. Throughout this process, the Governing Council will maintain optionality, data dependency, gradualism, and flexibility in the conduct of monetary policy. So, all four will matter, and there will be circumstances when one might be more important than another, and there might be other circumstances where the pecking order will change. So I think by doing that, we are trying to have as much optionality as we can, be able to use flexibility if and when warranted and necessary, be as data dependent as we have demonstrated and will continue to demonstrate, and also deploy the gradualism that will be appropriate given the circumstances. And I think in times of great uncertainty, gradualism is probably appropriate, more so than if the path is clear, well identified, and we all understand where we are heading. On the second issue, I just want to yet again come back to this issue of fragmentation, because I know that this is dear to some. I just want to reiterate that within our mandate, we are committed to preventing fragmentation risks in the euro area. Fragmented financial markets would obstruct the monetary policy transmission and undermine the possibility for the ECB to achieve its price stability mandate. And that's the reason we monitor constantly. And that is the reason we have available at hand all the dimensions of flexibility that can be applied to our reinvestment policies under the APP, under the PEP, because flexibility conditions are clearly associated with PEP to the extent that it relates to consequences of the pandemic. But we, as I said, we know how to design and we know how to deploy new instruments if and when necessary. We've demonstrated that in the past. We will do so again.
Thank you. And the next question goes to Eric Albert of Le Monde. Eric, please.
Thank you very much for taking the question. Given the scale of the inflation, it's no surprise that the ECB is acting. But still, could you explain, it's an inflation that's imported, that's mostly a tax on consumption, really. What can interest rate do against this kind of inflation? And also, could you come back a little bit on why do you not expect too much of a risk of a recession? You did explain a little bit, but could you expand on that, please?
Well, thank you for your question. It is a case that a large portion of the inflation that we have analyzed is attributable either directly or indirectly to terms of trade, what you call imported inflation, whether it is energy, exogenous bottlenecks, that is clearly an so-called imported inflation. But it's not it, because we are clearly seeing an unprecedented 75% of the items considered to measure inflation being above 2%. And that applies to non-energy industrial goods, it applies to services, and it is partly a factor of the energy pass-through, but not only. Number two, we are also very attentive to wages, wage negotiations, and to the risk of second-round effect and potential spiraling. We are not seeing the risk of spiraling at all, but we are seeing wage increases that have picked up, particularly since March, and that, as we indicated in the monetary policy statement, would not be entirely surprising, whether it is by way of catch-up effects or by way of general wage increase. We're also aware that Germany, for instance, will implement the minimum wage as of October 1st. So it is largely, and certainly much more so than in the US, for instance, to come back to your questions about the difference between the EU and the US, it is more so imported inflation than it would be attributed to overheating demand, as is probably more so the case in the US. But it's spreading more broadly than strictly speaking, in energy-related sectors. And then, you had another question. You know, it's a bit of a story of, on the one hand, on the other hand, the current situation of the economy. There is probably more of the negative hand than the positive hand, but we have both. And on the negative front, we clearly have the continued impact of the war, in particular, the reactivation of lockdown measures in China, which went away, then are maybe slightly coming back, the bottlenecks impact that it induces and the dampening effect it has on growth, not to mention the reduced disposable income that some of the households are suffering. But on the other hand, you have entire sectors of the economy that are recovering. And when you look at the tourism industry, the accommodation industry, hospitality, those sectors are really recovering at a fast pace. And you know, we looked at, on a per-country basis, at the prices of hotels, of restaurants. It is clearly on its way up, with a strong demand in those sectors in particular. And we cannot exclude also, we hope, that remains to be seen, that some of the factors that have a dampening effect on growth will gradually fade a bit.
Thank you. And the next question goes to Eshe Nilsson of the New York Times. Eshe, please.
Thank you. Good afternoon. You talked of raising all three key interest rates. Is the intention to keep the spread between those consistent as they have been so far? Will that change further into the future? And then my second question is on, can you talk a little bit more about the conditions that would trigger the flexibility within a PEP? And do they have to be specific to the pandemic being the causes? Or could you say that actually consequences of the war in Ukraine or some other shock that we haven't envisioned yet could also encourage that flexibility usage? Thank you.
Thank you very much for your question. In relation to the July rate hikes that we discussed, we certainly considered that the three rates would be impacted by the hike, not just the DFR. For future references, as of September, we might also apply the principle of hikes to the three, but we have not discussed that yet. And I think the intention will probably be to have a close look at that and to determine whether or not we want to just keep those spreads or return to a better symmetry between those three. That's clearly to be debated at either our next meeting or the September meeting. On the conditions that would trigger the anti-fragmentation, let's be clear. The critical point is monetary policy transmission, and we are very attentive to make sure that it transmits throughout the entire euro area. So there is no specific level of yields increase or lending rates or bond spreads that can unconditionally trigger this or that. The principle is that we will not tolerate fragmentation that would impair monetary policy transmission. And we will determine on the basis of circumstances of countries how and when that risk is likely to materialize, and we will prevent it.
Thank you very much. I would like to turn now to WebEx and take a question from a colleague in Frankfurt.
Oh, we had forgotten WebEx because you're all here, which is so much nicer.
So Andres Stumpf of Expansion, your question, please. And please turn on your camera and your mic. Andres, for the time being, we can't hear anything.
Can you hear me now?
Yes, wonderful.
Okay, I wasn't able to unmute myself. I have another question, Madame Lagarde, about fragmentation. We are today experiencing a new sell-off in sovereign bonds, and this might point that the PEP reinvestments and maybe the ECB new commitment is not enough to prevent fragmentation. Has the ECB any news on how the new or the adjusted tool could even look like? Thank you.
Thank you very much for your question. I can only repeat what I have said, which is that we will not tolerate fragmentation that would impair the proper transmission of monetary policy throughout the entire euro area. We do have existing flexibility that is embedded in the reinvestment of our PEP in particular, and we have demonstrated in the past, we will demonstrate if necessary in the future, that we can design, we can deploy the appropriate instrument to prevent that risk from materializing. Thank you.
Thank you. And the next question will go to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Good afternoon, and thank you for taking my questions. President Lagarde, I have two questions. One is on the importance of data dependency. And looking beyond September for rate hikes, the Governing Council will adjust the monetary policy and it will depend on incoming data. Can we expect then lift-offs to come on a quarterly basis, coupled with the macroeconomic projections? And my second question is on financial stability, because you mentioned it. You mentioned that You mentioned that banks will be facing credit risks increased due to tighter financing conditions. How concerned are you about financial stability in a war situation? Thank you.
I have to tell you that I'm concerned about the war, full stop. But your question goes further than that, of course. And the financial stability side of the question, I will defer to my esteemed colleague, friend, and Vice President de Guindos. The first one, yes, we are going to pay a lot of attention to data. And we are considering data dependency as one of the key 4 principles according to which we will operate. And obviously, the quarterly projections that we produce are, very rich, inform our decisions best. But we cannot be unattentive to developments and to data that we continuously collect, both at the ECB and within the national central banks as well. So we are not going to put ourselves in a straitjacket of only taking decisions when we have projections. So with that, I'd like to hand you over.
Thank you very much for the question. You know that in our strategy review, we included a reference that twice per year we would include financial stability considerations in our monetary policy making. And, we did it in December and we have done it now in June. And here, the message is quite clear. The vulnerabilities of the financial system in Europe have been defined in our financial stability review, refer to problems in terms of valuation of financial assets, in terms of margins of the banks, and in terms as well of high valuations in some spots of residential real estate. So the conclusion that we have reached, that is included in the monetary policy statement, is that in the short term, the normalization of monetary policy conditions can give rise to additional stress in the short term, but in the medium term, the tightening of financial conditions could be positive in order to try to address some of the vulnerabilities. Think about residential real estate. So, this is the main conclusion. And, we try to make an assessment that covers not only the short term, but as well the medium term.
Thank you very much, Vice President. That brings our press conference today to a conclusion. Thank you very much for coming here.
I would just like to add something, because we are here standing in Amsterdam, and my colleague Klaus Nott is with us. And for those of you interested, we had just a fantastic meeting that was organized under the auspices of the De Nederlandisch Bank, under the leadership of Klaus. And it's been just a really good, fruitful and productive experience. Geography matters, and hospitality can help a great deal. So thank you to the Netherlands, and thank you to the National Central Bank of the Netherlands.
And our next scheduled press conference is on 21st of July in Frankfurt.
Hospitality in Amsterdam is not helping out this bond market. From New York City this morning, good morning, good morning. Let's talk about this price action. We're set up as follows for the euro on euro dollar, following a decision from the ECB to keep rates unchanged, but tears up for a move in July and maybe a bigger one in September. Euro dollar just a break of 107 at 106.89. Here's the move in the bond market. This is where things get interesting. In Germany, a 2-year yield higher by about 10 basis points. On a 10-year, just a little bit lower, higher by 6 basis points to 141. That curve flattening. This curve isn't. In Italy, what a breakout on an Italian yield curve, up by 16 basis points on a 2-year, up by almost 20 on a 10-year to 355. Let's call it 356, pushing 360. So in July, we're set up for 25 basis points. What about September? The ECB president leaving the door open to a 50 basis point move?
The answer is yes. The calibration of this rate increase will depend on the updated medium-term inflation outlook. And here's the important one. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at our September meeting.
Let's head over to Amsterdam and catch up with Bloomberg's Maria Tadeo. Maria, run me through your takeaway of the last hour.
Well, Look, Jonathan, I think in many ways she just confirmed what we got from the statement, that this is the end of an era for the European Central Bank. Of course, we're heading into a 25 basis point hike in July, and there will be now another one in September. That was on paper, and she repeated that verbally. They're, of course, opening potentially the door for a 50 basis point. She did not push back against that. But I think for me, the real takeaway, and if you're listening to the number of questions, there was this idea of fragmentation. She got 4 questions on fragmentation. She repeated, we can't afford that. We're going to deal with that. We've done it in the past. We've done it in the future. But however, there was a lack of detail that I think when you look at the market reaction, especially BTPs, the spread, also the way it's moving on the German one, it was underwhelming. And the fact that she kept repeating the same answer without actual details of it, I think that was very, very underwhelming. And you're coming out of a conference where a lot of investors right now, especially if you trade the BTP, it's not obvious which way the central bank is going to go, but also how ready they are to provide this buffer, and in particular, what shape and form.
Which is why we're seeing some big moves in this bond market. Maria, great work as always. Maria Tadeo in Amsterdam with the European Central Bank on tour this time around. You heard the opening bell ring there about 40 seconds in. We're down 0.4% on the S&P. On the Nasdaq, we're down by 0.5%. No real drama here. But over in Europe, this move in Italy, in Germany, it gets your attention. It got the attention also of Mohamed El-Erian, who tweeted the following: "The more I listen to ECB President Lagarde's remarks, the more I feel that this Governing Council meeting will be remembered as marking the official recognition of a consequential secular change in both the economic outlook and the policy regime." We get lucky this morning. Mohamed joins us right now. Mohamed, let's start there. Your takeaway from the last couple of hours.
You know, it started by being a somewhat more hawkish outcome. And then the more I listened to President Lagarde, the more I realized that she was signaling this consequential change in the policy regime. This is a big deal, what went on in Europe. And I think the market reaction is indicative that the market is starting to understand that we've exited one regime and we've entered another regime. You know, if you listen to her carefully, she almost said that 50 basis points would have been the right move today if it weren't for the history of not having moved for a long time. That is quite a statement. And it opens the door, not just a little, wide open for 50 in September.
Some people will struggle with this, Mohamed, this idea that they can be gradual when inflation has an 8 handle and rates are still negative 50 basis points. And they'll only be going 25 basis points in July. So what we face, Mohamed, is Europe going through a whole summer of high inflation with interest rates still negative. Now, Mohamed, I get it. It's a big change for someone that's followed the ECB for a long time. I get all that. But when you look at where policy is relative to where the data is right now, that's a long summer, isn't it?
It is a long summer. But, John, you also rightly showed and tweeted about Italian spreads. And that is what's holding them back. They really are worried about fragmentation. So they're going to have to strike that very delicate balance. As I said, I think that they would have rather go 50 than 25 in July, and they may still do it. You know, I wouldn't rule it out completely, but yes, they are late. Yes, they've got to get going, and she stressed it's a journey. She kept on talking about the journey that they're starting to embark on. So she's trying to give a very clear message that if you net present value what they intend to do, it's equivalent to moving quite a bit early on.
Should we talk about this journey together? For July, 25 basis points. For September, in the statement, this is what it said. The calibration of this rate increase will depend on the updated medium-term inflation outlook. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at the September meeting. Then they went further, Mohamed. I was surprised by this. I thought they'd tee us up for July, give us something for September, but then to say we'd see gradual and sustained hikes after that. We're now thinking about not just interest rate hikes for the first time since 2011, not just exiting negative rates for the first time since 2014. Mohamed, we're thinking about a rate hike cycle at the ECB. You and I have spent months talking about what is achievable for the Federal Reserve. Given the breakdown that we're seeing in the Italian bond market, which is recovering just a little bit on my screen at the moment, how achievable is a rate hiking cycle at the ECB, and what does it actually look like from your standpoint?
So I think it is achievable. I think it's achievable if only their own forecast is 6.8% inflation for this year. Their own forecast is 3% for next year. So they've got to move. I do think they have the tools to counter fragmentation pressure. What the market is nervous about is they didn't hear details, but they have set up mechanisms to counter fragmentation. The worry, John, is unlike the Fed, the ECB has only one objective, and that's inflation. And the real economy is going to suffer. Look, I'm willing to bet you, John, that when we get the next set of revisions, growth will come down even more than what they've brought it down. And remember, we are in mid-year. I'm amazed to see how big the revisions are for the current year, given that they're happening in June. Look what the OECD did and the World Bank did earlier this week. There's a major downward revision of growth going on around the world.
I want to speak to those revisions right now, Mohamed. As you speak, we've got them on the screen. 2.8% is the GDP forecast for this year. It's down from 3.7. The inflation forecast now 6.8. The previous was 5.1. I had a guest earlier when I asked them, Mohamed, is it achievable to get 2.8% growth in Europe this year? And they said no, recession. You've said the same thing before. These central bankers don't forecast recessions, Mohamed. They certainly don't do that if they're forecasting higher interest rates either. What do you think those revisions will look like on the growth side, coupled with the pressure on the inflation side?
So I suspect we will get a lot lower than the current 2.8% this year, with a few countries of the Eurozone in recession. Why don't they project it now? There's enormous institutional inertia. I worked in a multilateral for a long time, and I can tell you it's very hard to make major revisions unless you're in the midst of a crisis. So we should expect the next round of revisions, and that's true not just for the ECB and the Fed, but also for the OECD, also for the World Bank, to include further downwards revisions in growth and further upward revisions in inflation.
What do you think takes priority? The inflation side of the story or the growth side of the story, when they meet again in September and the revisions evolve in the way you expect them to?
Inflation for the ECB. That is their objective. That's what they're going to be judged on. They are way behind, and they've got to move. So inflation, and the tone of President Lagarde was completely different from anything I've heard from her before. This is quite a significant change in tone.
She was asked 1 million times about fragmentation, Mohamed. I wrote down some of the stuff she said. Within our mandate, we are committed to preventing fragmentation risk in the euro area. And the why, it would undermine the ability of the ECB to achieve its price stability mandate. Now, from my vantage point, others too, Mohamed, some people might sit here and say, are they contradictory goals to try and avoid fragmentation risk and also to tighten financial conditions sufficiently to bring inflation down? The ECB is saying they're not. What do you think?
I think they're not. And the phrase that you should have written down, John, and I'm sure you did, is monetary transmission. She linked the two by monetary transmission, that if you get fragmentation, you will not get the proper transmission of monetary policy. And that is correct. As I said earlier, John, I think they have the tools to counter fragmentation. So the fear of fragmentation is not going to get in the way of this journey of higher rates.
We're going to spend some time talking about the Fed in the next segment, Mohamed, but I wanted to tee it up with you, just as the ECB as a reference point. How different is it with this ECB joining the Federal Reserve in this tightening cycle in a way that it just did not play in the last 10 years? This feels so different to me. The ECB sat it out last time around. It's not this time around. The BOJ sat it out last time around. They're trying to do it again. That's an interesting element in all of this as well. But Mohamed, just your thoughts on that at the moment.
Oh, it is very different. I mean, in fact, you could argue that the ECB has leapfrogged the Fed. President Lagarde spoke about how they looked under every stone to figure out why the inflation forecasts were wrong. The Fed hasn't done that yet. The Fed hasn't explained to the marketplace why its forecasts were so wrong. She then talked about a journey going beyond September. The Fed hasn't been as explicit. Their guidance is really till September. So in a funny sort of way, not only has the ECB joined the Fed, they've leapfrogged the Fed. And you saw that initial reaction in the FX market as the marketplace recognized that this was a significantly more hawkish ECB than the statement suggested. I mean, the press conference will be looked back, I think, as a seminal event.
Just watching this Italian 10-year story fade just a little bit more. We were positive more than 20 basis points on a session, now up just 15. Mohamed, I want to keep building on this with you. The ECB is playing in a rate hiking cycle in the way that it didn't with the Federal Reserve. You think this is becoming the more important story slightly, perhaps? The BOJ's not. This has consequences for foreign exchange. We're seeing this push up against dollar yen. Dollar yen through 134 overnight, seemingly at one point pushing 135. It could have consequences for the bond market in a way that we didn't see in the last cycle either. Mohamed, I've been surprised by how quickly some people have got comfortable with the idea that we might have seen a peak on a 10-year yield in early May at 320. Comparing it to what we experienced maybe in late 2018, this time around, German yields aren't sub-zero, they're positive. As you sit and look at bonds at the moment, Mohamed, how big a change is that, and how does it influence your thinking on where this bond market is going?
So I think we're having a general tightening of financial conditions around the world, and I think that's important. Yes, Japan is the outlier, but look at the functioning of the Japanese government bond market. It is not functioning well. It's clear that it is reaching the natural limits to unconventional policy. So even Japan is going to have to somehow exit from the regime that they're in. So this is a consequential change in the bond market. It's clear for what happens to the front end of curves. Once you get to 10-year or beyond, you have to worry about the growth implications. And that's why you've had this incredible volatility that we've seen in the 10-year in the US because of the different growth outlooks that have played out. John, I would keep a really, really close eye on the functioning of these bond markets because, as you know, there's three sorts of risks that the market are having to navigate. One is interest rate risk. They've navigated that rather well, not perfectly, but rather well. The second one is credit risk. They're embarking on this now. And the third one, which is the ugliest of all, and we don't want to have to navigate it, is liquidity risk.
Well, Mohamed, I'm not sure there's even a market in the JGB market in Japan at the moment, as we both witnessed this week. Another trading day. Haven't seen that this year, I don't think, so far. Another trading day of no trades whatsoever on a 10-year JGB. Mohamed, we're lucky. We're going to get another segment in with you, and we're going to talk about inflation, which is due tomorrow. Looking at this equity market at the moment on the S&P, we're down 0.5% with some movers. Just quickly, here's Abby.
John, a bit of wild action here on that ECB decision because, of course, ahead of it, the U.S. 10-year yield had been lower. At that point, tech higher. Then it shot up 4 basis points, bringing tech lower. And even though the 10-year yield is now flat, we still have big tech reverse lower. Apple down 0.8%. KeyBank also seeing signs of softening of demand in U.S. NVIDIA, they signed a partnership with Hynix. That stock is lower, however. One outlier, Tesla, up 1.2% on some positive trends in China. And then speaking of China, Alibaba cooling off after a 28% three-day move. Today down 4.4%, maybe because of the yield story and also the idea that there could be limited lockdowns in Shanghai this weekend. Alibaba right now down 4.4%, similar to U.S. tech right now, tech.
Abby, thank you. Coming up, inflation, top of mind.
Look, inflation is the bane of our existence. Inflation is mostly in food and in gasoline at the pump.
Except it's not, because core inflation is also running at 6%. Tomorrow, we're looking for another big print. We'll have that conversation next.
We're the strongest economy, and that's allowed us at least to stay on top of and a little bit ahead of what's happening around the world. Look, inflation is the bane of our existence. Inflation is mostly in food and in gasoline at the pump.
The latest read on inflation in America, 24 hours away. The administration and investors bracing for another elevated print. With more, here's Katie Lyons.
To be 8.2% on the headline for the month of May, John. And of course, even if that is a slight moderation from the prior month, when you look at the month-on-month figures, it's expected to be a higher number, about 0.7%. So prices are still climbing and wages are not keeping pace. And that's really the problem for the Biden administration, because the American consumer is feeling the pain, especially as for the last 2 months straight, the primary consumer expenses, fuel, power, and grocery store food have all been rising at double-digit annual rates for the first time since 1981. Food prices up nearly 12% in May. That's going to be one big contributor to the headline number. Another is the spike in gasoline prices. Pump prices up 8.2% last month, still climbing, now near $5 a gallon. They have more than doubled over the course of the Biden administration so far. But of course, neither gas nor food goes into that core metric. When you back those out, the print is expected to be softer, 0.5% month on month, 5.9% year on year, as you see demand moving out of goods, consumer discretionary goods, and into services. But our economists here at Bloomberg Economics, John, say that speaks to the mistake the Fed made. What started as supply side goods driven inflation has now widened out to services, which is stickier. And that means 50 basis points is going to be the move for maybe longer than this market expects, John.
Kelly Lyons, thank you. Still looking for a headline number with an 8 handle potentially. Month over month core is what this market will look at. Wall Street will be focused on, and even there, 0.5% is the estimate so far. That's elevated. We're lucky. I've said that 3 times now. 3 times a chime. Mohamed, thank you, sir, for being with us still. Let's go there. What are you looking for from CPI in the United States tomorrow?
So I have no reason to have a different forecast from the consensus of 0.5 and 0.7 month on month. But what worries me, John, and you're not going to like this because it's looking forward, the June month on month print will be worse than the May month on month print. I think those who boldly said inflation has peaked and it's coming down may have to change their minds. I wouldn't surprise me if we see a headline print that's much higher than the 8.5.
Next month. Mohamed, why?
Not as early as next month, because first, the drivers of inflation are broadening, and that's due to the Fed policy mistake. Secondly, at the headline level, energy prices are going up month on month quite dramatically. And thirdly, we're seeing pressure on shelter and food. So if you look at all the components, it's way too early, unfortunately, to say that inflation has peaked. I hope it has, but it would not surprise me if we go above 8.5% on a yearly basis.
Hey, Mohamed, this is really important. I remember when you gave me the call early last year, and you said, I don't think this is transitory. This is important. I'm pushing back. And you went out there in force, and that force got more powerful as the year progressed. I get the feeling this year, Mohamed, that we still haven't totally relinquished this idea that a lot of this is temporary. I hear from a lot of guests who think that we've seen the peak, a mechanical peak year over year, and for good reason. And they think the Fed backs away in September. Are you stressing this is going to persist through the whole of this year, that we're not going to get that drop off that so many people are hoping for, looking for?
John, if we get a drop off, we'll get it for the wrong reason. We'll get it because of demand destruction, and that would be tragic. The last thing we need is for inflation to completely undermine the demand side, because then we have not only a price issue, but we have an income issue. And once again, it will be the most vulnerable segments of the population that get hit the hardest. So in a way, be careful what you wish for. So if you believe the labor market stays strong, wages remain buoyant and start catching up to inflation, then it's very hard to see inflation coming down. If, however, you think that we're going to have a recession, sure, inflation is going to come down, but that's not the sort of transitory inflation that anybody wants.
Can you take any confidence from the labour market prints we've had recently, Mohamed, that we've seen robust jobs growth, yet we haven't seen unemployment come lower, we haven't seen wages accelerate? Can you take any confidence? Is there any sign whatsoever that we are slowly getting the supply side response that can alleviate some of this pressure?
Yeah, I certainly do. To be clear, recession is not my baseline. You've heard me say over and over again, it's stagflation is my baseline and recession is my risk scenario. John, the only thing I wish for on the labor market side is higher labor force participation and higher wages, believe it or not. That's the only thing that's missing. Otherwise, this labor market is very strong.
So when we wake up in September, we've had 3 more inflation prints going through the summer, and they sit down at the end of September at the Federal Reserve. Jackson Hole's behind us, all of that, Mohamed. What do you think the Fed has to confront, and how do you expect them to confront it?
I suspect first they'll be happy that most of the blame will have gone to the administration, unfairly so. You know, when I look at the mistakes made or the drivers of inflation, the administration comes fifth. However, it is the administration that's going to be blamed. So I think there's been some relief in the Fed that people won't quite understand how much of this is a Fed policy mistake. But second, they're going to have to be much clearer about their path. And you've heard me say this, much clearer about what mistake are they willing to underwrite. Because right now, they are so late, John, that there is no first best policy response. That was last year when you and I were discussing it. Now, it's about minimizing the mistake. And they're going to have to make a choice and stick to it. The worst thing is a flip-flopping Fed. A Fed that hikes rates and then pauses in September, then starts hiking again and then pauses again. That would just mean that stagflation would persist much longer than it needs to.
Mohamed, you were right, they were wrong. And we're lucky for a fourth time to catch up with you, sir. Thank you very much for being with us. Mohamed El-Erian from Queen's College, Cambridge there, breaking down the latest move from the ECB, looking ahead to CPI tomorrow and looking ahead through this summer, the challenge that the Federal Reserve faces, a challenge in the minds of Mohamed and others of their own creation in some ways. Coming up, the market moving events you need to be watching. Your trading diary is up next. "25 minutes into the session, equities doing okay. Unchanged, treading water, if you will, going into CPI tomorrow at the ECB. Unchanged on the S&P 500, positive just a little bit on the Nasdaq by 1/10%. Following the ECB, rather, some of this price action settling down. CPI tomorrow is your trading diary. President Biden delivering remarks at the summit of the Americas at 2 p.m. Eastern. Then tomorrow morning, it's the main event. US CPI coming on Friday, followed by the University of Michigan Consumer Sentiment Survey. Looking ahead to next week with US PPI on Tuesday, a Fed rate decision and Chairman Powell news conference next Wednesday. Then it's the Bank of England's turn with its own rate decision on Thursday. And finally, it's the Bank of Japan's turn next Friday. So a ton of really important central bank decisions coming next week. Before we get there, US CPI. And this country facing another headline print with an 8 handle. This market focused on the core month-over-month read, and even that is looking elevated. From New York, this is Bloomberg.